Alright, we just finished going through Navitas Semiconductor's Q2 2026 earnings materials, and we want to walk you through what we found. Here's the thing, the headline said Navitas lost 95 cents a share, missing estimates by something like 22 times, and the market bolted for the exits. And I'm telling you, the market fled a ghost. That 95-cent loss, almost entirely a one-time accounting charge with zero cash behind it. Underneath, the real business is accelerating. So today, let's separate the noise from the signal. Let's put the two numbers side by side because this is the whole story. The headline, 0.95 GA loss, a miss of about 200 scary, right? Now the reality, strip the noise and the non-GAAP loss was just 0.04 a share, and revenue actually beat expectations by 7%. Here's what caused the gap. That 0.95 loss was driven entirely by a 2.3 million one-time non-cash SPAC earn-out accounting charge, not operations. Meanwhile, actual Q2 revenue came in at 10.33 million, up 22% quarter over quarter, and management guided Q3 revenue up another 28%. So the bottom line, the way we read it, the operational business is accelerating and the headline loss is a cleared accounting artifact. The market quite literally fled a ghost. Let me explain what Navitas actually does in plain English. You'd think an AI data center's biggest need is compute. It isn't. It's power. From the grid all the way down to the GPU tray, electricity has to be stepped down again and again, and traditional silicon chokes at that job. That's the bottleneck Navitas attacks. It builds power chips using two next-gen materials, gallium nitride, GaN, and silicon carbide SiC, both more efficient and denser than old silicon. Now the pivot, Navitas walked away from low-margin consumer phone chargers and zeroed in on high-margin AI infrastructure. And here's the moat. It's a rare pure-play power semiconductor company wielding both GaN and SiC. Most rivals have only one. Having both is a genuine dual-weapon edge, and we'll see exactly why that matters in a minute. Now the autopsy, because this is where the ghost gets dissected. 3 bars. On the left, the GAP loss of 0.95. In the middle, a positive 0.91. That's the 2021 SPAC deferred earnout. It's one time, it's non-cash, it was triggered by old stock price targets, and critically, it's now fully recognized and cleared from all future statements. Add it back and you land on the third bar, a non-GAAP loss of just 0.04. And here's the key inside the deck flags. The actual operational loss was 11.4 million. Which is actually a slight improvement from the 11.7 million operational loss in the prior quarter. So the business got a touch better, not worse. The market compared a P-reality to a non-GAAP estimate, apples to oranges, and panicked. Once you separate them, the fear evaporates. Growth is easy to claim, so let's check its quality across the 4 pillars the deck lays out. 1. Revenue scale, with 10.3 million up 22% quarter over quarter, landing at the high end of guidance. 2. Margin expansion, 39.5% non-GAAP gross margin, up 0.5 points sequentially and a full point year over year, driven by the shift to high power product lines. 3. Balance sheet strength, 557 million in cash and equivalents and 0 debt. 4. Ammunition in toughly. They raised roughly 73 million at 21.89 a share to fund capacity and M&A, and deliberately built inventory from a 14.9 to 19.5 million, stockpiling TSC wafers to be ready for incoming AI orders. To be fair, a loss-making company raising at a high price is also a tell about its own burn rate. But that war chest is very real. This is the quarter's real headline, and it's a big one. Navitas 2.0, the transformation, completed a full quarter ahead of plan. Look at the mix shift. In the past, roughly 90% of revenue was legacy mobile and consumer, just 10% the new stuff by year end. The deck projects high power and AI infrastructure at about a third of revenue, with legacy mobile shrinking to strictly immaterial. The metrics behind it, high power segments growing over 50% year over year, AI data center revenue growing over 50% quarter over quarter and accelerating, and mobile consumer tech now immaterial to the bottom line. Rebuilding your entire revenue base in a handful of quarters and beating your own timeline by 1, that execution is genuinely impressive. I'll say that plainly. But impressive doesn't mean risk-free, and we'll get to the risks. Here's the growth backbone, and it all hangs on data centers moving to 100-volt power. The deck breaks it into 4 steps. Step 1, the second half of 2026 into the first half of 2027. SiC aggressively replaces legacy silicon in AC-DC power supplies just to meet basic power density needs. That's happening right now. Step 2, mid-2027, the critical inflection where the 800V bus moves to the power sidecar, bringing high voltage CC and new GaN content to the cabinet side. Step 3, the second half of 2027 into 2028. DC-DC conversion moves right onto the GPU tray, and high-frequency switching makes GaN mandatory at the compute level, so-called native 800V Step 4 2028 and beyond solid-state transformers converting grid power straight to 800V, bypassing legacy infrastructure entirely. 4 steps, each one bigger than the last. Now let's decode it. Management's pitch on the left, our translation on the right. They say the transformation is fully complete. I'll read. A deliberate narrative shift designed to re-rate the stock from a speculative gamble to an established infrastructure player. In plain terms, to lift the valuation multiple. They say the 800V transition has 4 distinct tipping points. I'll read. Managing expectations, pushing core revenue visibility out to 2027 and 2028 to preempt any panic over short-term deployment delays. And they say they uniquely offer both GaN and SiC. I'll read. And this is the smart one. It's the ultimate hedge. It secures content value no matter which specific material scales first in the 800V ecosystem. So notice the pattern. Every claim is doing double duty, positioning the story as much as describing it. Here's the sharpest question the street asked. Will 800V slip? Let's weigh it honestly. The bull case, a highly diversified pipeline, dozens of active programs across multiple hyperscalers, and early GaN-SiC adoption already delivering baseline growth that insulates against any single client's delay. The bear case, massive revenue dependencies where the most lucrative phases, steps 2 and 3, are locked behind mid-2027, and cloud hyperscalers change architectures constantly, which introduces real delay risk. The DEC's own execution confidence rating is telling high credibility on the short-term baseline growth, but only 7 out of 10 on the big 2027 800V explosion, heavily dependent on second-half program advancements landing on time. Our take lines up. Near term is solid, but the fat part of the payoff is a bet riding on 2027. Or maybe 70% on that one. 4 flashing lights on the radar before you get comfortable. 1. The profitability horizon. Navitas is still burning 11.4 million a quarter in operations, and there's no firm timeline for breaking even. 2. OPEX creep. Operating expenses are set to rise 1 to 1.5 million a quarter, about 10%. It's a spend to win phase that needs strict monitoring. 3. 800V timing risk. The bulk of the AI payoff relies entirely on those mid-2027 data center rollouts staying exactly on schedule, and schedule slip. 4. Litigation shadows. Brewing intellectual property battles, with Wolfspeed and Renesas both filing patent suits against Navitas right before earnings. None of these are fatal on their own. Stacked together, they're the reason you keep one hand on the brake. Let's sit with the lawsuits because they cut 2 ways. The threat side is real genuine legal costs, potential margin drains, freedom to operate risk, and a tangible uncertainty growth investors hate. And note the setup. Wolfspeed plus Renesas, which is a 39% Wolfspeed stakeholder, both filed GaN and SiC patent suits just days before earnings. But flip it. The CEO dismissed the suits as desperate harassment, and the analytical reality he's pointing at is this. You don't sue the player in last place. Incumbents tend to run to the courts precisely when they're losing physical market share. So the timing oddly works as an indirect validation of how threatening Navitas technology has become. It's the CEO's spin, sure, but paired with this quarter's revenue momentum, it's a spin worth taking seriously. Here's where the analysts aim their fire. On 800V timelines, asked 4 times, management firmly maintained the 2027 structural timeline despite rumors of specific cabinet cancellations. Answered with conviction, green light. On the magnachip strategy, asked twice. A clear rationale. They're securing dedicated 8-inch wafer capacity to expand the addressable market, not pivoting to an IP licensing business. Green light again. But on revenue, mixed granularity, also asked twice. This is where they stonewalled. They explicitly refused to break down the exact split between high-performance compute and data centers, or between 2027 committed orders and programs still in qualification. Red flag. The takeaway is clean directional questions got answered with conviction, but the granular math questions got actively dodged. Confident on the direction, silent on the precise numbers. Step back, and here's the architecture of the whole gamble. It all routes through the 800V power transition. The bull path 800V scales on schedule in 2027. The dual GaN and SiC strategy captures value across every step, and that 557 million cash runway lasts all the way to operational break-even. The bear path 800V hyperscaler timelines slip to 2029 or later. Scale fails to outpace those rising operating expenses, and the IP litigation drains capital. And the DEC's own conclusion is refreshingly blunt. Navitas is not a value play. It's a high-risk, high-reward bet where the strategic pivot is proven, but the massive scale and the profitability both remain entirely in the future. That's the honest one-line summary of this stock. Last one. The KPI Watchlist for the next 12 to 18 months, 6 things to track. 1. Real 800V order flow. Look past the roadmap. Watch for tangible Phase 2 and Phase 3 volume orders materializing in the first half of 2027. 2. AI revenue concentration. Track whether AI infrastructure actually clears a third of total revenue by year. And 3. Margin expansion. Monitor the trajectory past today's 39.5% with guidance pointing to 39.7% next quarter. 4. OPEX discipline. Verify that 1 to 1.5 million quarterly creep stays strictly below revenue growth. 5. Cash burn. Defend that 547 million and track the quarterly operational drain against the runway to profitability. 6. Global Foundries 8-inch GaN progress. Watch for full customer sampling by year-end and qualification by early 2027, critical for the US supply chain. Alright, last thing, radar always leaves you a light. On Navitas, I'm calling it yellow. And don't misread me. The transformation execution is genuinely impressive, and that 0.95 loss really was a market misread. The problem is what holds up the valuation. The big 800V payoff sits out in 2027 and beyond behind 3 gates, no profitability timeline, rising OPEX, and live litigation. Too many variables. So I lean cautious yellow. But I'll say it up front, if those Phase 2 volume orders show up on schedule in the first half of 2027, or management finally lays out a credible path to break-even, I flip this to green, and I'll own the call. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.